We have 3 vacation homes like
yes,
idiots.
and one we kind of rent out occasionally, but it's certainly not an asset. It is a liability.
Yeah.
Robert Kiyosaki challenges the conventional wisdom that buying a house is an asset. In his view, a primary residence typically falls into the category of liability because it represents an ongoing expense rather than generating income. However, Kiyosaki emphasizes that there are ways to convert a house from a liability to an asset through strategic real estate investing. Today, we are diving deep into a topic that has been a game changer for many aspiring real estate investors: how to live for free using fourplexes and FHA loans. Yes, you heard it right, living rent-free through strategic real estate investing, FHA loans. Ready? First things first, let's talk about FHA loans. What are they and how do they work? These are government-backed loans designed to make homeownership more accessible for first-time home buyers. So, what are the benefits and requirements of this so-called FHA loan? One of the key benefits of FHA loans is the low down payment requirement. Your down payment will depend on where your score falls. You can put as little as a 3.5% down payment on an FHA loan if your credit score is 580 or higher. However, you will need a down payment of 10% if your credit score is between 500 and 570. How does it work? So, for example, if you're eyeing a fourplex with a purchase price of $400,000, you only need to come up with $14,000 as a down payment. That is incredibly affordable compared to other traditional financing options requiring a 20% down payment. However, FHA loans will require you to pay mortgage insurance, which is divided into 2 types of payments. You will be charged a flat fee of 1.75% of the loan amount at the time of closing, which can be rolled into your loan if you do not have the cash on hand. A monthly charge will also be tacked on to the mortgage payments to cover mortgage insurance for the life of the loan. This payment is also a percentage of the loan amount and is determined by the loan size, term, and loan-to-value ratio. Another requirement you have to look out for is the debt-to-income ratio. Your debt-to-income ratio is the total of your monthly debt payments as a percentage of your monthly gross income. To qualify for an FHA loan, your DTI should be 43% or less. To illustrate, let's say the monthly mortgage payment on the home you're considering would be $1,500 and your gross monthly income is $5,000. The amount of your other monthly debt obligations cannot be higher than $650. Fourplex magic. However, there is something magical about fourplexes. When it comes to a fourplex, there is a unique advantage in terms of income potential. The expected rental income from the other units in the fourplex can be factored into your overall income for DTI purposes. This can potentially lower your DTI ratio, making it easier to qualify for the loan. Lenders will typically consider a percentage of the rental income from the other units. They may use the actual rental income if you have a history of renting out the units, or an appraiser's estimate of fair market rent for similar units in the area. The rental income is then added to your gross income. This higher gross income reduces your DTI ratio as it increases the denominator of the ratio of your total income. With a lower DTI ratio, you appear less risky to lenders because it shows you have more income available to cover your monthly debts, including the proposed mortgage payment. Keep in mind that these are just general qualifying criteria. Some FHA-approved lenders have stricter requirements for potential borrowers. It's best to speak with a loan officer to get a better idea of their FHA loan requirements. Live for free. Now, here is where it gets interesting. An FHA loan allows you to purchase a property with up to 4 housing units. This opens the door to real estate hacking. Kiyosaki sees this as a way to leverage the ownership of the residential real estate to generate passive income. You can now leverage your renters to pay your mortgage. When you own a fourplex, you live in 1 unit and rent out the other 3. The rental income from those units can cover your mortgage, property taxes, insurance, and even generate extra cash flow. Essentially, your tenants are helping you build wealth and live for free. It's like having your tenants pay your mortgage while you enjoy the benefits of home ownership and real estate appreciation. But it gets better. As your property appreciates and your mortgage gets paid down, you are building equity and creating a pathway to financial freedom. Play by the rules. There is just one catch you have to watch out for. FHA loans have residency requirements when you purchase a home with them. You will be required to move into the property within 60 days of closing and reside in it for at least 1 year. Be careful with respecting the rules because there are strict penalties if you ignore them. Violating the rules could trigger a fraud investigation by the FHA. Consequences can be imprisonment of up to 10 years and financial penalties of up to $100,000. The lender will also have the right to raise your interest rates, call your loan due, or foreclose on your loan. You are required to occupy 1 unit as your principal residence. Any other units can be rented out as soon as you purchase the property. As long as you play by the rules, you don't have anything to worry about. Build your real estate empire, and the best part? You can scale this process up to a real estate empire. After living in the home for 1 year, FHA will allow you to move out of the property and rent out all 4 units. But there is a catch. You can only have 1 primary residence, which means you can only have 1 FHA loan at the same time. That is where refinancing your FHA loan into a conventional loan comes into play. After living in your fourplex for a year, you can explore refinancing options to move into a new fourplex and start the process all over again. There is no limit to how many FHA mortgages you can get during your lifetime, but remember, you can only have 1 at the same time. It is all about strategic planning, smart investments, and taking advantage of the opportunities available to you. Don't wait any longer, and happy investing.